Hey guys, how's it going? It's Thomas back at you with another video. Today, I'm going to be doing something a little bit different. So usually I do somewhat of a commentary on various topics such as Dave Ramsey, AMC, and I give my thoughts on what's going on. But today I wanted to talk a little bit about investing and an investing strategy that's fairly common among just everyday investors. With this channel, I'm hoping to make a lot of different types of content. But one field that I do want to dive into is financial advising. I currently am studying that as a major. And so I'm really looking to utilize what it is that I'm learning here. And I have a great interest in this topic. So I'm hoping that I can share with you guys some knowledge that I've picked up. And hopefully, if there's something that you guys want to hear from me, or if there's something that you would like to contribute, go ahead and let me know. I'm always open to hear comments and thoughts about what it is that maybe I missed something, because we're always learning. Everybody's got a different way of going about it, but basically, don't be afraid to learn new stuff, no matter how old you are. Not that I'm really that old, but all right. So anyways, I'm going to just jump right into it. So today I'm going to talk about dollar cost averaging, which is a very common form of investing. And essentially, this strategy, what it does is you will take an allotted amount of money and reinvest it, well, not reinvest, but invest it into a fund at a specific time, consistently. So if you say, I'm going to essentially add this amount of money to my portfolio, you can do it either like every week, do it on a monthly basis, you can do it on a semi-monthly basis. I mean, I guess you could technically do it yearly, but at that point, it's kind of an odd choice since there's so much fluctuation in the markets. But let's say, for example, you have a portfolio and you have various funds in it. Now you decide that you are going to take each of these funds and you are going to invest a specific amount into it. And it doesn't matter so much what the cost of the fund itself is. What matters is how much you put into it. And I've actually found a picture over here that's, I think, explains it pretty well. So essentially, what they chose to do was they did a lump sum investment of $800 at like $10 per share. And then from there on out, they invested $100 each month. Now, the value of this stock rose and fell with each given month. It was up $20 here, it was down $7 here, it's up 15 here, down 5, down 6, down 6, and then up 10. But here's the thing, and this is where the strategy of this idea plays in, is that it's not the highs that are where you look at your gains. It's when your stock, in a sense, bottoms out, because sometimes they do. And if they're on the rise, that's no problem either. But what it does is it gives a stability to your existing stock. So if at any point you invest in a stock, suppose that you invest in a stock that's $10 to start. Well, the next month, when you go to add more to your portfolio, well, now it's down to $7. Well, that doesn't matter. You are continuously investing $100 each month. And it doesn't have to be $100. It can be as much as you want. Now, I suggest you make it a little bit more to make it worth your while, because you want to have as much effect on your portfolio as you can, but also, different strokes for different folks. Everybody's got a different financial idea. Some people want to do less than 100, some people want to do more, and that's perfectly fine. And here's the thing too, it's per investment. It's not your whole portfolio. So you're not saying, well, I've got $100 here and I'm going to split this among my portfolio however I want, however it goes. Now you can do that. But the thing with that is, if you say, okay, I have 5 different funds of $100, I'm going to go ahead and put $20 into each of these Well, that means you will be going in with the intent of investing $20 each month without fail into these funds. And the point of this is, if the stock loses value, if you bought it at kind of a high price and it drops down lower, well, now you're essentially buying cheap shares. It doesn't matter. And it's supposed to counteract what it those semi losses there. So you might be thinking, okay, I don't want to buy into a bad stock. I don't want it to crash. But the reality is the market is continuously growing. And so if you invest at a low point, you come back for your next one, it's at a lower point, you put that money in. So that way, eventually it reaches back up to the average. And when it does, you bought a ton of cheap shares and you will be making quite the return on that. Now, here's the thing too, that there's two things that I want to say about this that are more my personal input on this. As far as investing strategies go, I do think this is a good one. I can't say it's good for every fund though. And here's what I mean by that. I myself am a very safe investor. I don't like to take a lot of risks. I just, it's not in my nature. But there's such a thing as the saying, no risk, no reward. And that is what it is. And there's truth to that. That's been proven time and time again. But in spite of that, when you choose to use this strategy, I encourage you to use it on a fund that is not highly volatile. So I don't encourage this with something such as Bitcoin or Doge or something hyperinflated. So, I'm all for AMC. I love the movement. I'm hyped for that 100K. But the reality is that it is a very hyperinflated stock. I don't encourage investing a continuous amount with this strategy in mind. I'm not saying don't continuously invest in AMC. Now, that goes against the whole movement. The idea is that we continue to invest in it and push it. But at the same time, to apply the strategy to it would probably not be realistic because we're not looking at a continuous up and down sort of trend line. Whereas there's more stable stocks. They're ones that aren't that don't have as strong of an influence on them, such as one that I really like is General Motors. I like their stock. I like that it's very consistent. It's not a very up or down sort of stock. And, I think this strategy would work well with that. You invest a certain amount each month and you continue to do that. Now, my other thing with this is this kind of plays into consistency with the markets. And here's the thing. You can't really beat the markets. There are people that get lucky and can do it. And, but to say that there's a set strategy to do it is not correct. When we try to apply consistent rules to an inconsistent game, it won't work. So as always, I say, be careful with your investments. There's no perfect investing strategy, but I will say that I think this is a good one. And, part of this too is recognizing the stocks that you have. There's some ones that are going to be more risky and they're going to be more volatile, but then you balance that out with like some safer stocks. And that's the whole point of investing. The risky ones could get you the big rewards or the big losses, but you have those anchored down with a stable stock. And so, as I say, like I've said before, do your research. Don't just blindly buy into anything. Don't just blindly jump into something. Understand what it is you're getting into. The more informed you are with what it is you're investing, the better off you'll be in the long run. And so, this will conclude the video. It's just my brief summary of dollar cost averaging. If you want more information on it, I do like Investopedia. They're one of the best for really anything investment related. They're basically Wikipedia, but for finances. I think they're great. And also, if you have a question for me, go ahead and put it in the comments. I'd love to hear back from you guys. Make sure to like, share, and subscribe if you like this content or if you want more like this. And I'll make sure to get back to you with another video very soon. Have a good one, guys.